So, hello everyone. Today we will discuss an important economic development. According to BMI Research, Business Monitor International, India's economic growth rate is expected to moderate to 6.6% in FY27. This estimate is also broadly in line with the forecast of Reserve Bank of India (RBI). But what exactly does this mean? Why is growth expected to slow? And what role do GDP and inflation play in this forecast? Let's understand. So, what is GDP? GDP or gross domestic product is the total value of all goods and services produced within a country during a specific period. A simple way to understand GDP is it factorizes produce more goods, farmers grow more crops, companies provide more services, and consumers spend more money. Then GDP increases. GDP growth indicates how fast our economy is expanding. For a developing country like India, a growth rate above 6% is still considered strong compared to most major economies. Now, what is the current forecast? BMI research has projected that India's economy may grow at around 6.6% in FY27. This is slightly lower than the growth rates seen in some recent years but remains among the fastest growing major economies globally. The RBI has also projected approximately 6.6% growth, suggesting that both institutions expect moderate but stable economic expansion. Now, why is growth expected to slow? First, slower private investment. Investment is one of the key drivers of economic growth. When businesses build factories, purchase machinery, expand production, they create jobs and increase economic activity. However, if companies become cautious due to global uncertainties or low demand, investments may slow down. This reduces the pace of GDP growth. Second, modernization in consumer spending. Consumption contributes nearly 55 to 60% of India's GDP. If households spend less than consumer goods, housing, vehicles, and services, overall demand in the economy weakens. Factors such as inflation, high borrowing cost, or slower income growth can affect consumer spending. Third, global economic uncertainty. India's economy is also influenced by global conditions. Challenges include geopolitical tensions, disruptions, high energy prices, and slow growth in advanced economies. These factors can affect exporters and investment flows into India. Understanding inflation, what is inflation? So, inflation means that sustained increase in the general price level of goods and services. For example, if milk costs rupees 60 today and rupees 66 next year, if fuel, food and transportation become more expensive, inflation is occurring. Moderate inflation is normal, but very high inflation reduces people's purchasing power. Now, why is inflation important for GDP growth? There is a close relationship between inflation and growth. If inflation becomes too high, people's real incomes fall. Consumption decreases, businesses face higher production costs, and economic growth may slow. And if inflation remains under control, consumers continue spending, businesses invest confidently, and economic growth remains stable. This is why the RBI focuses heavily on controlling inflation while supporting growth. And now let us understand what is the RBI's role in this. So, the Reserve Bank of India manages monetary policy. Its main objectives are which include maintain price stability, which control inflation, support economic growth and ensure financial stability.
The RBI uses tools such as repo rate, reserve repo rate, cash reserve ratio, and open market operations. If inflation rises significantly, the RBI may increase interest rates. If growth slows too much, it may reduce rates to encourage borrowing and investment. Now, is 6.6% growth a concern? Not necessarily. Even at 6.6%, India is expected to remain one of the fastest growing large economies in the world. Countries such as US, Germany, and Japan often grow at much lower rates. The key challenge for India is to sustain high growth while controlling inflation and creating employment opportunities. Now, if we see this from the UPSC perspective, so the prelims points include in this, it is GDP, gross domestic product. Second, inflation is measured mainly through CPI and WPI. And RBI targets inflation under the flexible inflation targeting framework. And investment and consumption are components of GDP. Main points were which include challenges: weak private investment, global economic uncertainty, inflationary pressures, and employment generation. Opportunities are infrastructure development, manufacturing growth through Make in India, and digital economy expansion and democratic dividend. Now, now I conclude my words by just saying that India's economy is expected to grow at around 6.6% in FY27 according to BMI research and RBI projections. While growth may be slower than in previous years, it still reflects a strong economic performance. The major reasons behind the moderation are slower investment and consumption growth. At the same time, controlling inflation remains crucial because stable prices support sustainable economic expansion. The real policy challenge for India is to achieve the balance between high growth, low inflation, and job creation, ensuring long-term economic development. So, I hope this whole information which I have explained to you, I hope this whole information will be very knowledgeable and very much fruitful for you, very much good for you. I hope you have got something from my efforts and from my information which I delivered to you related to the news. Due to the India's economic growth rate to weaken at 6.6% in FY27 on slower investments and consumption BMI. I hope this information will be very fruitful for you. So, at the last, thank you so much.